They're limiting withdrawals. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major U.S. asset manager is limiting withdrawals as investors race to get out before the next crash. And many people thought this would be a story just limited to the banks, cutting withdrawals, limiting access to funds. And we're already seeing signs that investment management firms are doing the same thing. And during the next bear market, I want you to understand that this is going to be the tool that many investment managers use to keep people from selling. I want you to understand why this U.S. asset manager is limiting withdrawals and which sector is going to be at the epicenter of this next crisis where investors will be trapped. And is the U.S. government finally getting the picture that we're headed into the recession? Well, the recent economic data they published says no, and we're going to show you why, that they're going to have to wake up really soon as that data is likely to come crashing down. And in a follow-up to our story yesterday, Saudi Arabia announces why they're behind this big push to raise oil prices, but that I want you to understand is the real story is why we're going to hear something very similar from U.S. corporations in the months to come. Let's over to Bloomberg, where we picked today's story up with a headline. Blackstone's B-REIT saw $4.5 billion of withdrawal requests, but get this, they only let $666 million worth go out. The rest of those requests were all denied. And this is a story, again, that we talked about during the banks, limiting people's access to their money, and what people are starting to wake up and realize that during the next crisis, if we see a deflationary crash, the solution will be not only keep people from taking their money out of the banks, but keep them from taking their money out of the investments. And Blackstone is at the forefront of this right now. The firm restricts withdrawals to about 5% a quarter. The B-REIT had already hit a 2% monthly limit in January and February, leaving investors with a narrower path out in March, which of course is why we saw them racing to get their redemption requests in, only for most of them to be denied. And the real estate industry has come under pressure as investors seek to reduce their exposure, which has become proportionally larger as prices of other assets fell. Property owners are also facing much higher borrowing costs, which led to more defaults in certain troubled areas as offices. And it's not just a story of higher interest rates. This is a story that we know that predominantly older investors love dividend income. They love that recurring style of income from their investments. And so they made a large amount of investments in corporate property and real estate. And what we're starting to see now is due to the work from home trend that started mostly during the pandemic, a lot of these buildings are starting to find vacancies, and they have a problem because when we talked about this in a prior show, the way these corporate offices get structured are in separate corporations from whoever the parent company is. So if they need to default on the loan, well, they do, and it doesn't impact anything else. So what you're seeing is the landlords are facing a decline in rent. They're going to want the banks to come down and work with them. The banks are not in a position to do it, and now all of a sudden, investors are starting to realize when the prices of these office buildings come down, they're the ones who are now trapped. The structure was designed both to prevent a liquidity mismatch and maximize long-term shareholder value, and is working as planned according to BlackRock. In fact, the B-REIT has paid out nearly $5 billion to redeeming shareholders since November 30. Meanwhile, there's another $4.5 billion that would love to have their money. And we don't take deposits. Our structures are meant so we're never forced to sell assets. This according to Blackstone's global head of private wealth solutions. So I want you to understand this is a Hotel California type of setup. You can come in anytime you want, but you can never leave. And that's the whole plan of why they set this up the way they did, because the idea is these corporate buildings, these large office buildings and complexes, they're not liquid. So all of a sudden, if they said, hey, if you want your money out, we'll give it to you, and they had a flood of redemptions, well, they're going to have to go in the market and dump these buildings that they're likely going to find themselves upside down in, take a further loss, and not to mention the fact fact that these things don't actually sell really fast to begin with. So Blackstone's solution was really simple. You can invest all you want, we just won't let you have your money. And you can see why, the corporate office space, these REITs and other REITs like this are going to be at the forefront of the next crisis when asset prices come crumbling down and investors are eager to get their money and will get a big denial button instead of the option to sell. And here we can see part of the problem with other articles like this one coming out of the Wall Street Journal. Distress in the office market spreads to high-end buildings. So when you see headlines like this and you're invested in that space, you start to think about, it's not the return on my money, it's the return of my money. And investors start to get worried that, hey, maybe this just isn't a problem for the banks. It's going to be a problem for me too. And that means I'm going to lose if I don't get out of this investment before it's too late. And the amount of U.S. Class A office space in central business districts that is leased fell in the fourth quarter last year for the first time since 2021, according to Moody's. And of course, we note that a number of high-end property owners have recently defaulted on their mortgages. And again, you start to think about, as an investor in this space, you start to wonder, wait a minute, are the buildings that I'm invested in through whatever this REIT or other vehicle I'm in, or am I actually going to continue to see the income I'm getting? Or is there a big crash in office prices coming that I'm going to absorb as an investor and still be unable to get my money back? Analysts expect office defaults to increase as mortgages that were signed before the pandemic expire. No surprise to that. Around $2.6 trillion in commercial mortgages are set to mature between this year and 2027. Most of those loans held by smaller banks, which is going to be, again, what we're going to say is a double whammy for these small banks. If they can somehow get through this deposit flight issue, the next issue they're going to face is defaults on all these commercial properties that they were big lenders against. The owner, Brookfield Asset Management, recently defaulted on more than $750 million in debt backing the building and another Los Angeles tower. Meanwhile, asset manager PIMCO recently defaulted on a mortgage backed by portfolio of office buildings, including Twitter in New York and San Francisco. So again, you start to see these headlines, and investors are going to get worried. They're going to want their money, and they're going to get locked down and locked out. And I believe that we're going to see banks do the same thing. I think the government's going to be behind. I think we're probably likely to see a banking holiday during the next crisis, and somehow that's going to turn into asset managers digging into the legalese of their contracts and finding a way to keep people from getting out. What do you think? Is that a possibility? Do you think there's another outcome? Love to hear from you. Weigh in the comments, because the question is the government now starting to figure out that perhaps the economy is slowing and that we're heading into a recession? Well, not yet. The data isn't quite validating that, but I want you to see why in the not too distant future, the government's going to have to wake up to the reality and start showing this data is coming down in a big way. And that's going to have major implications, not just in how people view the economy, but how the Fed continues to tighten at a time when the data says perhaps they shouldn't be. U.S. factory orders tumbled in February as the ISM signals collapsed to come. This headline from Zero Hedge. I want to dig back into, we didn't look at this deeply. I said we would. This is the ISM manufacturing data. We touched on a bit of it yesterday, but something I want you to see is, you notice this backlog of orders is in contraction at 43.9. So you think about backlogs being inflationary. So if you have a business and you have a whole bunch of orders stacking up, well, that means business must be good. Your current production line is running, you've got people working, and you've got enough demand where you've got a backlog of orders, and that means you can raise prices. But if your current production demand starts to fall, well, what then in turn happens to your backlog? Well, of course, you've got it, it's going to decrease, and then what you'd expect to see is inventory start to contract. Well, because you don't need as much inventory if you don't have as much demand, and if you don't have as much demand, you don't need as many employees, which is why we saw that employment contract a bit, as we talked about in yesterday's show. And so now let's take a look at the government data, because I want you to see just how far off they are from reality and what that means in terms of how quickly that data is going to come down. And when it eventually does, it's going to shock everybody. Here we can see U.S. manufacturers' new orders came out today. Month over month, this is now down to 0.7%. So we see new orders. Of course, that is important in terms of a growth indicator, a leading indicator for the economy. It's headed down on a year-over-year rate of change. It's decelerated to 2.7%. And here, this is a wonderful chart because, again, I don't have access to the ISM data. In chart form, what we can see here, this again from Zero Hedge, is the ISM manufacturing Purchasing Managers Index in red tends to lead the official U.S. manufacturers' new order data from the government. And you can see this right now. I mean, you can see this ISM decelerating here. What it tells us is the government data should be falling lower. And if it actually did, if you could only imagine if the government data was falling that lower, we might actually hear a different policy response from the Fed. We might hear something different out of the White House and Congress and all these other people and experts that are saying the economy is great, when in fact maybe it's just a big massaging of the data by the data collectors. And here we can see manufacturers' new orders using our own chart against the Philly Fed new orders. This is the same chart we showed in yesterday's show. So except the red part from yesterday's show, new orders from today. And what we can see is as the Philly Fed's new orders decrease, we see in blue, of course, we see the headline data. And you can notably see that most of these times these two data series follow each other, with the Philly Fed often leading the trend down and then the manufacturing data being more smooth. But really what perhaps the real story is new orders are just a proxy of the stock market. Here you can see the Wilshire 5000 against new orders, both on a year-over-year rate of change. The stock market in red leading new orders down. So what you can take away from this as is just a function of the wealth effect. So as people feel less wealthy, they tend to spend less. And if they spend less, demand for new orders go down. If demand for new orders go down, order backlogs go down. And if that goes down, inventory levels, well, you don't need that either. And then what does that mean? All of a sudden, people are then getting pink slipped and hitting the unemployment line, which takes us into our story, a follow-up from yesterday, because I want you to hear what Saudi Arabia is saying the reason is, and I'm going to tie that back to what you're going to hear from American corporations and small business owners in the months to come. It's going to be a similar answer, just in a little bit different way. This from Wall Street Journal: Saudi Arabia's oil production cuts reflect cost of reshaping economy. And you're going to start to hear a lot of this, that, hey, inflation's a problem. We have to have, a certain amount of price now to support our operations. So I want you to keep that in mind as we go through this. It's the second time in less than 6 months that the Saudis have disregarded U.S. concerns, despite significant potential ramifications on the bilateral relationship, that elevated oil prices would help fuel Russia's war machine. And yet Sunday's production cut is the clearest signal that Saudis will do whatever it takes to keep oil prices at level, key words, that benefit them. So I'll keep that in mind as we continue here. Prince Mohammed told associates late last year he was no longer interested in pleasing the U.S., saying he wants something in return for anything he gives Washington, according to people familiar with the situation. Of course, I guess that means perhaps they don't want U.S. Treasuries anymore, because remember how the cycle of this works. Of course, we buy oil with dollars. They have too many dollars, so then they recycle them back into Treasury securities. So the question I'm going to ask you is, should they get something in return? Are they getting a fair value, a fair deal for their oil with what we do for them, or do you think they deserve more? I'll let you weigh in, because now let's look at the last piece of this here. And we see the Saudis have to guard against downside scenarios of a global recession and the implications for energy demand, which could drive oil prices below a yearly average of 80 a barrel and create a budget deficit, which is exactly the case I made yesterday. And so look, the reality is here, they're trying to drive oil prices higher because their costs went up because of inflation. And what's going to happen is it's going to turn out to be the wrong move. Even if it means they need to take a loss now, it would be better for the global economy. Instead, it means the likeliness that oil is going to come crashing down. That probability just went up. So what we're going to hear now from U.S. corporations, small businesses across the gamut in the months to come, they're going to say, look, we can't lower prices either, which is why inflation tends to be sticky. And in turn, in order to defend it, well, that's why they're going to lay off people and say, look, we have no choice. We have to cut expenses. We've done everything we can. Now we have to cut heads, because the bottom line is demand's falling. And in a similar way, the Saudis defending their need for higher prices. Of corporations are going to defend the same need, just in a way that we don't want to see. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.